Good afternoon and welcome to our webinar on structured products. My name is Nande Boss and I am the Communications Manager at Grey Swan. We are in for a treat today because we'll be hearing from three incredible speakers. I say they are incredible because they not only know this subject matter very well, but they're able to articulate it and communicate it in a way that all of us can understand it. So what you can expect out of today is our three presenters, one being one of our financial advisors here at Grey Swan. His name is Bram Bredenkamp. He's going to take us through an overview of structured products. Then we will hear from Gregoire Taron, who is the head of manager research. Greg will tell us why it is still an opportunity and a great time for us to consider investing in structured products. And last but not least, we'll hear from Yapi Leber from Investec, and he will share with us a product that they have on offer called Advanced Investment Holdings Limited Structured Product. So without further ado, over to you, Bram.
Good afternoon, everyone. It's great to have you with us. What I'm going to do, I'm just going to look at some basics about structured products and take you on a broader basis through some points that might benefit you if you wish to invest in a structured product. So what are structured products? It's a fixed term investment providing you a certain level of capital protection and a predefined investment return as well, which may be enhanced or just 100% participation in the underlying asset's growth. And then this return is dependent on the performance of the underlying asset, for example, your equities or indices, etc. So the issuer of a structured product normally utilizes traditional asset classes such as equities, bonds, and derivatives, as I've mentioned, to compile a specific payoff profile. Now, the payoff profile refers to the balance between downside protection and upside participation. The risk profile refers to the investor's capacity to handle certain kinds of investment risks. Now, a cautious client might rather opt for a larger extent of capital protection, where aggressive clients may opt for a high investment return and a lower capital protection. In your direct offshore currencies, you get products that are linked to your foreign indices, such as the S&P 500, the FTSE 100, or the Euro Stoxx 50. In your rand-based products with offshore exposure, returns may be affected by the appreciation or the depreciation in the rand value, as opposed to or in conjunction with other currencies. Then what are structured products? Again, usually they are invested through sinking funds, endowments, which provides you a certain tax and estate duty benefit. Now, liquidity is provided. You may withdraw the funds before the product's maturity, but if you do so, you may realize a loss, as you will only take part in the actual performance of the underlying asset. If you look at the risks in investing in structured products, it's mainly funneled into three categories. Your counterparty risk, that is where the institution providing the guarantee, whether the capital protection or the enhanced investment return, is unable to make the required payment on a trade or a transaction. Then when you have a look at your credit risk, this is where debt instruments are used to attain investment objectives, and the borrower or the debtor cannot repay the loan or the debt. Then your liquidity risk. I have already referred to this. You need to stay invested for the full period of the investment product to take full advantage of all the benefits. As I said, you may withdraw your funds early, but you will forfeit any capital protection or the enhanced yield if you do so. So in practice, how do you access a structured product? There are numerous ways. I'm just going to focus on two of them for today. The first one is directly through the institution providing the product. In the case of Investec's current product, the minimum investment amount is, as we've mentioned, 10,000 British pounds or 13,000 US dollars. If you invest through a sinking fund or an endowment, the minimum investment amount may be higher because you will have to adhere to the rules of that specific administrator. For instance, it might be a minimum of 25,000 units of the currency that you decide to invest in. Now, if we look at the specific benefits of a sinking fund or an endowment, we're going to start off with the simplified tax administration, as the tax is recovered within the investment itself. It's never handled by the actual investor, so any tax is paid on behalf of the investor within the investment structure. The beneficial effective tax rates for high income earners. The investment income within the investment is taxed at an effective rate of 30%, and the capital gains tax is deducted at an effective rate of 12%. You have insolvency protection. The entire value of the policy will be protected against creditors after the first 3 years of the policy have passed. And then no restriction on maximum levels of equities and offshore investments. So this is, in essence, a discretionary investment product. You just obviously have to adhere to the specific rules, as I have mentioned, but you don't have the same restrictions in terms of asset allocation that you have with retirement funds. Then after the initial 5-year period, it becomes an open-ended investment. But if you do continue with the investment, you do keep the tax and estate planning benefits as such, as long as that investment is in effect. And then if you look at the estate planning benefits, in that sense, this investment will not form part of your estate should you pass away. And you can save up to 3.99% of this investment value in executors' fees specifically. Then when you invest through an endowment or sinking fund normally, you choose an underlying investment fund or portfolio. So when you then access a structured product through an endowment or sinking fund, the structured product will, for practical purposes, be your underlying investment instrument. If you look at the cost and the fees, 100% of the investment amount will be allocated because the fees are usually priced into the product. And that also means that the stipulated investment growth is stated net of fees. So no fees still need to be deducted if a specific investment growth is referred to. Then structured products are designed again to form part of a well-balanced and diversified investment portfolio. It's very important that you sit with your financial advisor to decide if there's a place for such a product, and if, where, and how big a proportion of your total portfolio you want to invest in a product like this. Such products can specifically add value where low investment returns are expected, or where investment markets are expensive or volatile, as we have been experiencing over the past 5 years or so. And on that note, I'm going to hand over to our Head of Manager Research, Greg Ron, for a short macroeconomic overview.
Thank you, Bram. Hoping everyone can see me. Bram, if you can just change so that I can actually just change the screen. Oh, you can run through it. It's fine. Afternoon. My name is Greg Ron. Thank you for joining us today and putting yourself away from watching the US election, which is quite closely contested. So firstly, Bram just asked me just to mention why do we invest into structured products and sort of what the underlying vehicles are. So most of the underlying structured products, the underlying vehicles are typically equities at this point in time. So this is just a slide from the 1900s to where we are today, and it's the S&P, so it's the American US stock market. And it just shows you over the long term that the stock market does make your assets grow. So you get growth over the long term. The point behind it is that if you go into that period where you look at 1929, when equity markets were very expensive from a valuation perspective. Then, you know, you go through periods of 20 or 30 years. If you had bought in at the peak, you wouldn't have made any money. Even in 10-year time frames, you would have lost money. So there's various of these periods. You can go into the last tech boom of the 2000s, where if you had bought into the equity markets at that point in time, in the 2000s, then it could have taken you 14 years to actually make money or just break even on your equity holding. So the point of entry into the equity markets is very important, and you typically want to invest when equity markets are cheap. Bram, if you can go to the next slide. So the next slide just shows you, this is the US 10-year government bond yield. So it shows you if you bought a bond or invested your money historically in cash, what you could have yielded. So if you go back to 1958 and you look at the blue line, you can see bond yields historically has been very high. So, you know, you had the option of buying bonds historically because it gave you a positive yield. The gray line shows that the yield or the interest you get on buying a bond or similar to cash relative to inflation. And what you can see at the moment, you can see the gray line and the blue lines coming down to zero. And currently, you know, the bond yields globally is yielding you 0.7%. That's it. And after costs, you typically zero or negative. And it's the same for cash. So the problem locally or the problem globally at the moment is that, you know, historically we had the option of buying into bonds or other asset classes. You really don't have an alternative. It's the only alternative at the moment is actually buying into equities, because cash yields and bond yields are basically zero. Bram, just to the next slide. So this shows you, so I mentioned in the first slide, buying into equity markets when it's cheap. So the question is, where's equity markets at the moment? So if you look at the middle line, dotted line there, the green line, that shows you the average price to earnings valuations of equity markets over the last 25 years. So that's the average. The top dotted green line shows you the one standard deviation event. And when the gray line is above that, that means equity markets are expensive. And that's the point we're trying to put in place here, is that, you know, equity markets are by no means cheap at the moment. It's trading at price to earnings valuations of 21.54. So it's way below, above its long-term averages. So firstly, you're not getting yield on cash or bonds. And secondly, equity markets are expensive at this point in time. So what are your options? Bram, just the next slide. You can skip over this one. So there we go. I would just like to show you on the right-hand side there. And this shows you that it shows you the historical price to earnings valuations, meaning the valuation of equity markets. And if you had bought into equity markets at a low valuation, then what has the equity markets historically done over the 5-year period after buying in? So the example, if you look at the x-axis there, where it says 11, at the bottom right there, and if you throw your eye up to the top where that orange regression line is, then on average, if you had bought into the equity markets when the price to earnings valuations were 11, then over the next 5 years, you typically made 18% per annum. The problem is at the moment with price to earnings valuations is it's above 20, and typically over the next 5 years, equity markets haven't given you a positive return. So it shows you that equity markets are expensive at this point in time, but again, there is no alternative. Bram, next slide. So in summary, in terms of investing into structured products, and which Yapi will speak about, is the first point is global bond yields and cash is not outperforming inflation at the moment. So it's really not an option investing into that for the long term. Secondly, you know, as interest rates starts going up, or as bond yields goes up, there's a real risk of losing capital if you buy into global bonds. So there's a big risk of losing money if you buy into bonds globally. So again, we don't think global bonds is an option at this point in time. At least equities provides you a dividend yield, so it pays you a dividend, and over the long term, it does grow. But the problem is equities is expensive. You're buying into equity markets at a high valuation, and bull markets typically do not start at high equity valuations. But there is no real alternative. The other point in terms of risks ahead, you have the US election today, and depending on who wins Senate today and who wins the presidential election, it might be very hard to push through further stimulus, and that will drive the US economy. If that doesn't come through, we could see a sell-off in the equity market. Secondly, we're worried about a debt bubble, and because of low interest rates. So there's a lot of risks ahead. And then thirdly, COVID-19 by no means are past us. You've seen the lockdowns in the UK, you've seen the lockdowns in Germany. And that's causing a lot of uncertainty. So there's a lot of risks at the moment buying into the equity market. So where do structured products come into play at this point in time? Well, we believe we call it TINA, if you look at the top of that slide. And TINA just means there is no alternative. You have to buy equities, you have to take on equity risk. And this is where structured products comes into play. You can buy equity markets at this point in time. You can get the growth in equity markets, but you need to build in some capital protection. For if we have a sell-off or equity markets doesn't perform, at least you do not lose money. And this is really where structured products comes into play. You have the opportunity to make money, but you have a capital protection in place. So on that note, thank you very much. Yapi, I'll hand over to you.
Fantastic. Well, yeah, great. While Yapi shares his screen, I want to just acknowledge you two gentlemen and thank you for that overview. I know Investec currently has the Advanced Investment Holdings Limited structured product on offer. So to tell us more about that, I see Yapi's ready with his presentation. So enjoy, everybody.
Yeah, thank you. So if I could ask you, I'll indicate which page numbers you want to page to. We'll start by just giving a high level here. So what we create is a company in Guernsey that's listed on the Bermuda Stock Exchange. Investors buy shares in the company. So the structured product is warehoused inside a company so that the investor owns a share. That's the critical asset that they own. And if you page down to page 3, maybe just to highlight. So what we're doing is we're creating a 5-year share, and the investor puts in $100, and the worst case in 5 years' time is $100 back. The best case is that the equity markets rise, and the investor gets 100% of the upside, be that 5, 10, 20, whatever the market does. Daily priced, daily liquid, and importantly, the investor has liquidity. So if during the term you want to sell, you can sell out. And I think, as has been said before, you sell out at the prevailing price. So to get the capital protection, it's best to stay the full 5-year. As far as how we do this, we get $100 in, and we're going to spend roughly 79 to place with Investec on a credit-linked note that references the South African government. That's going to give us an interest rate of about 5% per annum, being 2.3 per annum for Investec risk, plus 2.7 for the SA government risk. So the two together enable us to have a 5-year interest rate. 79 grows to 100 in 5 years at that propensity. Then we've got 21 left over. What we do with the 21 is we put roughly 6 aside for fees, costs, and expenses. And I think, as both Bram and Greg said, those are built into the pricing. That has the consequence that we've got 15 left over on the first day. What we do with the 15 is we buy a call option, which is struck at the money. In other words, gives us participation from 1 and from the prevailing level at the trade date. And so the consequence being, if the market goes down 40, then we get the $100 back from the debt. If the market goes up 40, we get that 40 from the market plus the 100 from the debt, so 140. So if you want to just page it down for us, Bram, to the page 4. So we had a look now, how would such a product have returned? What type of return would it have given historically? In this instance, the index is 98% correlated to the MSCI World All Country. And if we take that index and did a 5-year rolling return, it would have given us the light blue and the dark color if I had the physical exposure. If I had the structured product, which we're simulating here, I would have had a 0 when the market was negative in that dark colored areas. In total, over that entire term, and I think it was also clear from what Greg's input was, 20% of the time in the last 48 years, the market on a price-only basis was negative over a 5-year. It's that 20% which we're trying to avoid here. If that happens now, we don't want our investors to lose their capital. If you were to say, what would the returns have been like historically? Well, the average would have been, for that 48-year period, 8.53, the best being 32 in dollars, and the worst 0. Ram, is that clear? Can you guys hear me? I just want to check that you can hear and it's clear.
Yes, perfectly. Thank you.
Okay, perfect. Sorry, I just wanted to make sure. Okay, so that just shows you a simulation, because what we're trying to do here is avoid that downside. So if we take it forward, one page forward, what is it that the payoff looks like? So if you start with 100 and the market went down to 50, you still get your 100 back, because very importantly, you didn't buy the shares on the first day with your 100, or you didn't buy a unit trust or an ETF. You put 79 in the deposit, which grew to 100. And that's why you can get your 100 back. Then, secondly, if the market did 40, you get paid out 40 from the option, plus the 100, 140. Now, what we've done on the index selection is, because of the same reasons that Greg mentioned, how expensive the US market is, we agree with that, is we've made the S&P 500 only 40% of this basket, leaving 30 for the Euro stocks, 15 for the Nikkei, and 15 for emerging markets. Because our view is that the tech stocks are very expensive and they're dragging that market to those high multiples that we're seeing. And for this portfolio, we'd prefer to have more of a value style type of selection of indices as opposed to this just growth orientation. And that's why this portfolio on a see-through basis has just under 20% tech exposure, whereas the S&P would be 25 or plus. So if we're wrong, then we still got 100% capital protection. So if we page that forward. So we did a benchmark because many people use unit trusts. We just took the 816 equity unit trusts by Morningstar and did a comparison of how many of those fund managers would have beaten such an index, bearing in mind the index is price only, but that being after we've taken into account their expenses. So we take the average total expense ratio off their gross returns. And you can see there over the last 1, 3, and 5 years, roughly 50%. So what that tells us is that the fund managers in the best fund managers out there, on average, half of them are underperforming, half of them are overperforming. But importantly, this was a bull market. If we had a minus 40 type equity return market, then we think the share will outperform the majority of these 816 fund managers, because their mandate says they must be in equity, and it would be very difficult to avoid the losses. So that's why it's a nice blender of a portfolio. So if we go to page 7. So we just did a simulation to show what typically happens when the market crashes. This is a real live example. One of our shares that we did over the last 20 years was issued in this period of time that's in that light blue patch there over the world equity markets. And if you'd been in the live indices, which in that case, in that share was 50% Euro stocks, 50% Nikkei, you would have lost 44% at price only level. And if you added the dividends back, you'd still be 38 down. The benefit of the structured product is this. If you get to the end of the term and the market's down 40 or 45 and you get your $100, you don't take the loss. You can always go buy the market the next morning available at the discounted price, as opposed to having this loss on your statement. Now, first having to recover that loss before you get back to where you were. Sorry, just some admin here. Okay, so if we page down, this graph just shows you volatility. Why this is important is because the volatility affects the pricing of the options. If you look to the far right, you can see how 90-day volatility shot up with the COVID and is busy coming down again now that the markets are recovering. But importantly, if an investor says, but why don't I buy the ETF or just buy the market and then buy protection? You can buy protection. It's called a put option. And for 5 years, it costs you roughly 20% at present. So the reason it's so expensive is because of this very low interest rates in a situation where the dividends are actually higher than the interest rates. And that causes the put options to be very expensive because of pricing in the market. So if we page down. Now, this was also the point Greg was bringing out, and that is if you look at the 120-year average of asset classes, equities, this is MSCI World in dollar type of exposure, gave, with the inclusion of dividends, 9.6 per annum, and bonds averaged over the 120 years 4.9, and bills or cash 3.7. So if you stripped out the dividend out of that equities to give it a price only, you're probably looking at about 7.2 per annum. But what's important at the moment, and that's why it's important to see where the world's at, is that interest rates are actually where this bottom part of the graph is, i.e. between 0.15 and 0.4% per annum. So it's not where it used to be in bonds at 4.9 and cash at 3.7. So it comes back to this is basically the difficulty for the fund manager or for the investor is in a world where there's no interest rates. I mean, how much are you going to allocate to bonds? How much are you going to allocate to equities or even balanced funds? Because balanced funds, 40 to 50% is in the equity and the rest is just in fixed income. So our view here is that we're probably facing a binary outcome. As Greg said, because of how high the valuations are, and that's been pushed up by trillions of dollars of liquidity pumped into the system and cheap money, flooding of money. If the bonds and cash are giving very low yields, then the equity really remains the only plausible asset class. So if your timing is wrong, you could buy into a massive bubble and it could come tumbling down and end in tears. Or if you're not in the market, it could continue doing very well because of the fact that the interest rates aren't being seen to be going up anytime soon. And you've got this lots of liquidity that has to find a home. And the main asset class that can give it is the equity asset class. So that's really the big picture where we are in the world today. So if we go to page 10, just to show you what such a share does, because I started the discussion by saying that investors buy a share in a company, which is different to note structures. So Bram, if you look at most of the competitive products are sold as a note. A note has a maturity date, and when that maturity date comes, it requires the holder to be paid or settled in cash and have a tax event, i.e. pay capital gains tax or income tax. What the share does, like Advanced, is it says don't own the note. Own a share in a company that owns the note. The share in the company results in the shareholder being able to elect to roll the share. So we've used an example of one of our shares called Optimal, which started in 2004 at £1,000 per share and 11 Rand 16 to a pound, i.e. 11,000 Rand per share. It rolled for the first time in 2009. If it rolls, it means that you retain the shares. You have no tax. You only pay tax when you sell the shares. But commercially, the investor made in that phase 35% in sterling, had no liability for tax, and had a new capital guarantee. The new capital guarantee being where they locked in the return. So very importantly, every 4 or 5 years when it matures, the investor locks in their return and deleverages all the equity risk. And they're able to do that with no tax being triggered. So that's a very important principle. The other important principle is the tax. If you buy a share and it's denominated in a foreign currency and you bought it in your trust or in your own name, then you only pay tax on the profit in the foreign currency. So for instance, this share started at £1,000. It's worth now £2,116 per share. And if I sold mine, I'd pay tax on 111% in dollars, in the pound share, sorry, pounds. And I could elect either to pay at the final Rand pound exchange rate or the average for the last 12 months. But importantly, I only pay tax when I sell the share. And so this has got a big advantage. And if you take it, Bram, let's say I buy this through a Glacier wrapper or an Old Mutual or Momentum, it's available on all three of those wrappers, then I'd still only pay tax in the wrapper at the wrapper rate once I sell. If I'd bought a note or I'd bought a normal structured product that's structured as a note, then inside the wrapper, they'd have to deduct tax for me every time it matured. Okay, so if we go to page 11, now this also comes to the benefit of having the foreign currency and having the tax on the profit in the foreign currency is that there's probably about a 25% expected devaluation of the rand. This is just the forward pricing in the market, and it's not based on our opinion or sentiment. It's just the price at which you can enter into a foreign exchange contract. So as an investor, if you've got your money in dollars and you're going to pay tax one day when you sell only on the profit in the foreign currency, it helps a lot, the fact that you can defer that tax obligation. So if we take it forward, the fees and costs, I think that Grace One, is, to my recollection, doesn't charge upfront charges. So the rest of the fees are all built into the pricing. So you put $100 in, you get growth on $100, and you get $100 of protection. The fees are all built into the price, which makes it very valuable in the context of extremely low rates in the market as we speak. So that is what I would like to say, Bram, on the offering. What I would like to afford the guys is an opportunity just for us to share maybe for 2 minutes the SA government document, because at the end of the day, your risk here is, as your initial theory showed, is to the supplier, is to the issuer of the, so we need to look at the credit risk. So yeah, this page, just page 1 down from here, I'm happy you send this on to everybody, but maybe so as we don't have to take time on this, we can just go straight to page 3 of this document. Page, yeah, just there. So we had a look at what are the critical principles about the SA government. Now, let's understand where the SA government fits into this offering. The investor is going to get the $100 back on condition that Investec is fine for the 5 years and doesn't default on its debt, on senior debts, not subordinated. And secondly, the South African government honors and meets their liabilities for the 5 years. In other words, doesn't default on their debt. As to international players that own our debt, we managed to locate 40 massive buyers of SA government debt financial institutions, and we've just listed the top 10, being BlackRock, JP Morgan, UBS, Credit Suisse, Legal & General, Vanguard, Credit Agricole, Ashmore, massive big fund managers. As to the risk of the SA government, as we know, government and bonds and municipal bonds and corporate bonds, they trade at a multiple or a spread over US government. And at the moment, South Africa is trading at 2.86. We're the white line in that Bloomberg graph. For instance, Turkey, I think, is at 516 or 520. So they would be viewed much more risky than us. This would be the rate that an investor would need to be paid annually above US government for owning the bonds of the issuer. And in South Africa's case, in practical terms, that means they have to earn 2.86% in dollars per annum, more than they would be happy to earn over US government debt. The worst our credit spread's been in the last 10 years was 5 at the height of the COVID. So if you own a bond or own debt, there are 2 things that are critical. The first one is, what are the rules? What is the legal protection you have? And South Africa's is taken up in the National Revenue Account Dynamics. The Public Finance Management Act, which is part of the Constitution and is enshrined in the Constitution, requires that the government debt, interest and debt, be serviced as the first line of as costs that the government has. That plus, I noticed the president's salary and the MPs and the judges, but sadly not the general public servants or the 16 million grants that have to be paid out or other costs that the government might have to have. So Parliament can't change this. This is enshrined in the Constitution, and it is in line with World Convention, and hence we're part of the G20, and we can fit in with world financial markets and be given IMF loans, etc., because we comply with the rules. We're up there, right up there with the best as far as the protection legally offered. So the next thing that's important is your ability to pay. So if we go to page 4, and just looking at the SA government's position, we did a check of all the debt that they've got that the government have issued. And that's this bar chart at the bottom, which shows you the amount of loans that they've got to repay back and when they've got to pay back right through to 2052. The salmon color is the domestic bonds, that's rand denominated. And very fortunate for us, the foreign debt is only 10% of the total. So South Africa's finances are quite good from the perspective of not having an overextended amount of foreign debt. Now, the local debt, sadly, the government can tax us. They can bring in prescribed assets and they can print money. So for them to default on the local debt is fairly unlikely, simply because they will do things which will result in maybe the currency weakening, but the actual debt being just covered by more bonds. The one that they can't print is dollars. That's why we must focus on the dark color here, which is the foreign debt. And we've totaled that for the first 5 years as a total of 4.8 billion. And then South Africa got a loan from the IMF, I think at 1.5% interest rate of about 4.2 billion. So in total, their commitments in cash for the next 5 years is circa 9 billion. But they actually have gold reserves of 7.6 billion and foreign exchange reserves of 44 billion. So in capital and cash that's non-rand denominated, can't be influenced by SA directly, is roughly 52 billion, and the debt obligations is 9. So the reality is that we are checking, and one must check if they've got any contingencies that might come from guarantees given to SAL or to Transnet or to Eskom and the like. But the fact that one's got a liquid share, a daily liquid share, and the fact that the debt on the face of it seems fairly well covered is probably a lot of comfort to the investor. It also takes and helps us understand why the foreign investors are prepared to accept a low rate of only 2.86 per annum above US government debt. It's because obviously the analysts, they check out the affordability of the debt and they check out the rules, and the rules are strong and adequate. And at the moment, they can't command a higher yield on the debt than 2.86. So, Bram, that's the input from my side, but I'm very happy to take questions.
Thank you so much for that, Yapi. I think you gave us a comprehensive overview of the product and how it can be of benefit to maybe diversify a portfolio, investment portfolio. I'm going to allow questions. We do have time for questions, and I'm glad about that. My only question would be, because you mentioned in the presentation that there is 100% protection for capital. My question would be, practically, how does that translate? How do companies guarantee your capital?
Yeah, so what we've done there is that by buying that credit-linked note from Investec, whereby we've agreed contractually with Investec that if we give you the 79 and you using your own debt plus the credit reference to the SA government, you contractually undertake to pay us 100 back at maturity. So that's the way, unless the government reneges on their debt or doesn't actually honor that obligation, that instrument has to mature at 100 by contract.
All right. Thank you. I think that makes sense to me. Are there any questions from this big group of people here? Right, then if there aren't any questions, maybe you are shy to ask in this forum. I know that what we'll do at the end of this presentation is just collate a package for you that we will email to you. If something comes up, you're more than welcome to email us and ask us about this product or any other investment opportunities that you are keen to understand and learn about. We appreciate your time and looking forward to hearing from you again. Till then, stay safe.